All right, well, good evening, everyone. Welcome to the Fields Institute Quantitative Finance Seminar Series. My name is Sebastian Jaimungal. For those who don't know me, I'm a professor at the University of Toronto, one of the co-organizers of the series, together with my co-organizer, Silvana Pacenti, also from the University of Toronto, and Adam Metzler from Wilfrid Laurier University, and Matthias Griselli from McMaster. So welcome. This is our first event of the term, and it's a great pleasure to have our speaker here, who I'll introduce in a moment. But prior to that, I'd like to thank Waterfront International for their continued support of this seminar series through the years, as well as Scotiabank for their support through the Center for Financial Industries. And with that, I'd like to introduce our speaker for today, and that's Professor Christoph Frei. So Christoph is a professor of mathematical finance and the current chair of the Department of Mathematical and Statistical Sciences at the University of Alberta. He received a PhD in mathematical finance at ETH Zurich, and while you were working in financial industries at the same time, or at some point, and subsequently was held a postdoctoral position at École Polytechnique in Paris. His research includes collaborations with institutions such as US Federal Reserve and UBS, and it focuses on risk management and the applications of quantitative methods in finance. And today, Christoph is going to tell us all about a dynamic model for open banking. So join me in welcoming Christoph to Fields.
Thank you very much, Sebastian, for this nice introduction, and thanks all the organizers for inviting me to give this talk. So this is based on joint work with Ranu Castaneda, who is one of my PhD students, and that is sort of the main part of what I will show. Additionally, it is related to an earlier paper that's written by myself, which gives an overview of open banking. And in fact, I would like to start with an overview of open banking and explain what it is and give some recent developments, because both it's interesting in its own right, and it will serve as the basis then for the model that we will look at later. And if you have any questions during the talk, just let me know. So let me now start with a few recent headlines related to open banking, and we will get back to them during the talk in terms of what is the development in different countries. So let's start right here in Canada, where the federal government has mentioned open banking in the last year's budget, which is still the latest budget, with plans to introducing it. Then this headline is more consumer focused, where the question is how open banking could get you a better mortgage deal. Now, open banking is also a topic in various other countries. For example, this one south of the border, where there has also been some recent development related to open banking. And finally, the last one, which is very recent, that's related to the European Union's decision to block some of the big tech companies of accessing financial data. So now, first off, what is open banking? Well, very broadly speaking, it's about data sharing. And the idea behind it is that data has a lot of value, and in particular, banking data, because it tells you a lot about how consumer and businesses, what they did. And the idea of open banking is to give that data, the value of it, to actually the consumers or businesses, rather than just storing it within the bank. So that's a framework which allows consumers and businesses to share their banking data with third-party providers through secure channels. And third-party providers that can be particular fintech companies that offer new tools. This could be like a budget tool, but it could also be some product offerings like a mortgage that we saw in the example before. And the secure channels, that works usually through an application program interface, a short API, and that allows the communication between the bank and the third-party provider with the approval of the customers. This can include both read access, which is just viewing account balances and past transactions, but it can also include write access, which goes then beyond that and initiating a payment or opening a banking account. Now, there has been historically some alternatives in terms of giving access to data, and the oldest one is just downloading the data, typically through a CSV file, and then uploading that. And this is actually how some of the very first fintech companies worked in the model. And that has, first of all, quite a number of security issues, but also it's very inconvenient for the customers because, well, they need to manually download and then upload it again. And it's also the issue that it's sort of a static thing. So that's why that wasn't really popular, but it has been used in the past. Now, what's still being used is what's called screen scraping. And that is a process where customers share directly their banking login credentials with third-party providers. To illustrate that to you here, so the idea is essentially with screen scraping, they would just give directly their login credentials to the fintech company, and then that would access sort of their banking data. And the issues are, there are quite a number of issues. One of them is that the customer will sort of lose the control of what data is exactly being shared, but it also may be a violation of the terms, and it can cause security risk. Nonetheless, the estimation is that currently around 9 million Canadians, corresponds to over 20% of the population, are actually using this. By contrast, open banking has the idea behind it that there's this API that allows a control access of the banking data, and that still leaves the customer with the control. Now, that relates then to the opportunities that come with open banking, particularly in terms of customers. They can get easier access to innovative products, but they can also benefit from increased competition. And that will be then important later when we look at the lending market and how can that affect consumers. There's also improved financial tools, and it's just a better alternative than what the other possibilities are available. However, it also has sort of broader impacts. In particular, it can affect financial inclusion in terms of giving access to other groups of population, and that may include tools which have been previously reserved to wealthy clients. And it can expand overall the market of fintech and banks, can increase competition, and it also can give sort of the banks a new role as custodians of personal data. On the other hand, it also comes with risks. Of course, there are technical risks in terms of data breaches, and that highlights the importance of robust platforms and systems. But it also can relate to social risks, sort of the other side of the economic opportunities, in the sense that it can lead to discrimination, but it can also mean that people who may not want to share data, they actually may have worse conditions, because that will sort of be sometimes a discrimination against them. And it can also have broader economic implications in terms of more volatility in accounting balances and systemic risk from those ready transactions. Then the question about how this should be regulated, in particular when the regulation is being done at different levels, provinces and federal level, and the issue that it can have sort of a different competition, and that's sort of related to the last headline that I showed in the European Union. There's this question of competition between banks and fintech, and the banks may need to meet different regulations than the fintech. So That's why it can actually lead to more competition, but maybe that competition is not on a balanced playing field. Now, this slide here gives you an overview of the number of APIs in banking across different countries. So I just plotted this on sort of a worldwide map, and this so you sort of a measure of how widespread open banking is. And what stands out is the United Kingdom, because it really took a pioneering role in open banking. So that was where it was first introduced, and that goes back to 2018. And the idea there was increasing competition. That was the underlying idea, in particular in terms of the retail banking. And that started with some other ideas. So they also had first using sort of this download and upload idea of files and data, but that wasn't popular. So then now they use a different approach, and that approach led then to this open banking initiative, which was a mandate of the 9 largest UK banks to grant fintech companies access. And they also established a regulated platform that was then sort of the standard and that had to be used. So this was a mandate, or is still a mandate, for the 9 largest UK banks. And that set sort of the trend. Afterwards, this was used as a model for other jurisdictions. And it then also showed sort of what worked well and what could be improved. Now, overall, you see here the usage number in million of people. So it's at a slow start, but it's increasing. So this starts in 2020 and goes up to more or less now. And you see it now has more than 10 million active users, and that's over 15% of the UK population. Now that had then consequences for other countries, in particular in the European Union. There is a Payment Services Directive, which also gives a mandate to banks to allow third-party providers access to data. However, the regulation was then left up to the countries, and that's why the adaptation rate varies across different countries, and there's not really harmonized standards, and that caused some issues, and this is why sort of the progress there is slower. In Canada, the government has initiated steps, but it hasn't yet been implemented, and that these steps have been presented in last year's budget. And the plan still is to move that forward, in particular to expand the mandate of the Financial Consumer Agency of Canada to include the oversee of the Open Banking Initiative and the scope and participation in it. Now, in the United States, it has been a bit a forth and back. So it started with the Dodd-Frank Act, which is the major regulation after the financial crisis. And already at that time, it included the provision to give customers the right to access the banking data, but it wasn't specified how that should happen. And only last year that were rules introduced in last October, which gave a concrete plan for banks to allow and participate in open banking. However, in the meantime, the leadership that agency has changed for obvious reasons, and the rules has been vacated, and they are currently working on a revision, and it's not quite clear in which direction that will go. Now, just to mention a few other countries, in India, it's a bit a different approach, where they have a platform that brings fintechs and banks together, rather than giving sort of fintechs directly access to banking data. And in Australia, it sort of goes in a similar direction as in the United Kingdom, except that the speed is a bit less fast because they introduced this regulation a few years after the UK. Now, let me talk about related literature. There is literature about the implementation in terms of how that affects traditional banking systems versus an open banking system. I will not go into these details, but what is most relevant for us is sort of the economics. And the first paper I mentioned there by Babina and co-authors, that studies empirical effects, in particular using actually data from the United Kingdom, which has this pioneering role, and to study some of the effects of open banking. And that is interestingly then sort of mirrored in what we will see in our model, in particular in terms of worsening conditions for people who are privacy concerned and who prefer not to participate in open banking. Now, I also want to mention the paper by He, Huang, and Zhu, because that will be sort of the basis for our model, but that's a static model. And what we will use is this as a basis and then set up a dynamic model for sort of studying the interactions. So let me now come to the objective. So this would be a dynamic model where we're looking specifically at the lending market. Now, of course, you can have open banking has various aspects in terms of advising, in terms of transactions, and then the question about lending. And we are just focusing here on the lending market, and particularly between the relation then of banks and fintechs. We use this model that I mentioned just before by He et al., and we use the idea of a search and bargaining framework, which goes back to Duffy, Garner, Peterson. That's the 2005 Econometrica paper. And that is sort of a frequently used model for over-the-counter markets, which we will use here. And then we determine the differences between privacy conscious and non-privacy conscious agents, and analyze what is the impact of open banking on these agents in the lending market. So let me now start with our model, and in particular with the agent distribution. So our model will be in continuous time, and it has a continuum of agents. So just think of an interval 0, 1. And each agent in this interval has different sort of types. And the types have 3 entries. One is sort of the loan criterion, and that loan criterion is either they have a loan from a bank, from the fintech, or they have no loan, which means it's sort of very simplified in the sense that once they have a loan, they cannot get a second loan, and they can only get a new loan when the loan has matured and expired, then only after that. So it's only these 3 possibilities. Similarly, the type criteria, this is about credit quality. So we assume that there are high types and there are low types. The high types, they don't default, and the low types, they default when they are supposed to pay back the loan, and they will not pay back anything. Again, we make this very strong difference between these 2 types. And then there are privacy conscious and non-privacy conscious agents. The privacy conscious, they will never participate in open banking because they are worried about their data. They don't want to share that with anyone. The non-privacy conscious, they may participate depending on the benefits that they get. So if they think it's better, then they will participate. Otherwise, they won't. Now, we denote this new measure as the fraction. And of course, the fraction should be non-negative. And it should sum up to 1, because we just normalize that as an interval with measure 1. And then we also assume that these fractions of the high types and low types are constant. So we just denote the fraction of high types equal to theta, and that's assumed to be constant. And similarly, the fraction of privacy conscious agents is also assumed to be constant here, denoted by S. So there's no variation in that. That's constant overall. And now let me illustrate this again. That's based on the He et al. Paper. So what we're considering here, starting on the left, are these borrowers, and they have either high or low type with the corresponding measure or fraction theta and 1 minus theta, and they are privacy conscious or non-privacy conscious. And then, if they want a loan, then they will reach out to the bank and to the fintech simultaneously. And the bank and the fintech, so we assume here there's only one bank and there's one fintech company. Again, we keep that as simple as possible. And when they reach out to them, they do a credit check. And what's happening is that the high types, they will also always be recognized as high types. Whereas the low types, there it depends on the screening ability of the bank and the fintech. So that's here denoted by xj, and that is the conditional probability of sj equal to L, conditional on L being L. So this is the probability sort of to determine the right type, and that depends on the screening mechanism, which means that if xj is high, which means close to 1, then the company or the lender will be able to predict that this is a low type. And if it is a small value of xj, then that means there's a high probability that it will be wrongly classified as a high type, and that will be then in the uppercase. So both the bank and fintech do this upon seeing sort of the file, and then they decide whether or not to give a loan, and they decide about the interest rate. So the low types, because they will for sure default, they will never get a loan if they are recognized sort of as with this low signal, because then the bank and the fintech, they know that this must be a low type because the high types will never have that signal, and in that case they will not give a loan because because otherwise they would just take the default. Now, in the case of a high signal, they can decide whether or not to give a loan, and if so, at which interest rate. So that's the interest rate RB and RF. And now, as in, this has to do with sort of game theoretical reasoning. So there will not be a pure strategy equilibrium, but there will only be a mixed strategy equilibrium, which means here that the bank and fintech, they will both sort of randomize their interest rate. So that's why RB and RF will follow a distribution FB and FF. So that is the underlying setting. And let me just summarize this in words. So we have these two risk neutral lenders, bank and fintech. Then see that signal, and depending on the signal, they make the decision about whether or not to offer a loan. And as I said, if the signal is low, the loan will not be offered. If it's a high signal, then the loan will be offered at some interest rate that the bank and the fintech decide individually. And we assume that there's a maximum interest rate, which is denoted here by R bar. And that is just sort of incorporates the idea that that often there's some regulation which doesn't allow for higher interest rate than a certain maximum, and that implies then a participation condition, which is stated here, and that just says that the bank and fintech are then willing actually to offer a loan, because if sort of if there's too many low types and the interest rate cannot be high enough, then they will not offer a loan just because the risk is too high, or in other words, the expected value will be too low in the sense that it will not compensate for the risk of a default. And that works then similar to the Hay paper, where under this condition, so assuming that that both lenders have satisfied this condition, then there exists a unique mixed strategy equilibrium. And mixed strategy means here that these two interest rates will be offered. Now, if only if the PC condition is satisfied only for one of them, then they will just offer the loan and the other not. And of course, if it's not satisfied for either of them, there will just be no transaction at all. Now, using this
Christoph,
idea.
Quick clarification question. Could you go back 2 slides? Great. So is the misclassification probability the same for the bank and the fintech? That's part 1 of the question. And part 2 of the question is, do they always classify the type the same? So if the same individual went to the bank, they'd get, maybe they get misclassified, they're low and they get misclassified as high. Would the fintech also misclassify them as high? Or is it possible that the fintech classifies them correctly?
Okay, yeah, great question. So first of all, they do this individually, which means that the XJ for the bank and the fintech will be different. And we will also look at sort of a state before open banking and after open banking. So that will also then change, in particular, change the probability of the fintech. And they can do that. They do that individually. So they don't know. I mean, as you would probably expect in reality, it's like the bank doesn't know what the fintech sort of did. And it wasn't clear from the... Yeah, I understand. And that's actually an interesting thing, because it's sort of then introduces a winner's course in the sense that if only one of them makes an offer, then that actually may be because the other one found out that that it's sort of a low type. So that, in the sense, yeah, it's not always good to be the one who actually then offers the loan. So that complicates a bit things. But yeah, that's a good point. So yeah, so they do this individually, and the XJs are different for the two. Okay, and now we go back to the agents distribution. So that was the this measure mu, and what we can do here is looking at the dynamics and write this down as a differential equation. So I will just explain maybe the first one. So that will be the dynamics for the ones who have a loan from the bank, are high type, and are non-privacy conscious. And that's just the measure. So when does this measure change? Well, it changes if there are additional types that get a loan from, or different agents get a loan from the bank. So these are these from here, the N, which currently don't have a loan, but they will get a loan if they decided from the bank. And that's exactly this alpha, which is the frequency at which they decide to take a loan from the bank. And on the other hand, well, that measure is reduced when the loans mature. So this is the frequency of the maturation, and that's denoted here by delta. And there's no other change. So there are only these two changes. And the very same thing happens sometimes for all the others, except that for the ones that don't have a loan, there it goes in sometimes in the opposite direction. And it can go then, of course, in both ways. It can be either for the fintech or for the bank. So that's why there's a bit longer equation down here, where you have then both of these terms. And if we assume that alpha will be constant, and that will be at least in the a constant in terms of time, and that will be at least in the steady state, then we can obtain an explicit solution of just sort of an exponential form, because the whole thing is a nicely linear differential equation. And in particular, we can also look at the measures of these types in the steady state, and we can find them explicitly in terms of the initial conditions of these proportional, that's given by this constant z, and in terms of the decision alphas. So the alphas at this stage are still sort of unknown, but they are not time dependent. And now, how do we determine these alphas? Well, the idea is exactly that we're looking at an optimization problem. So that optimization problem is about the agent's wealth in the bank account. And first of all, what do they maximize over? Well, they maximize over the consumption, that's the gamma here, and the decisions of taking a loan from the bank or from the fintech. So that's why we maximize over gamma and alpha. And then what is the objective? Well, the objective is the expected discounted consumption, and that's what this expression here says. So that's the discounted expected consumption, and that needs to satisfy some conditions, in particular a condition in terms of the agent wealth, and in the bank account that's given here by the W. So the W changes depending on the interest that that is in the savings account. Then it decreases if there's consumption, and then it also decreases when interest needs to be paid. So that's the expression here, and that just shows here that the interest rate, that would be the interest rate for the bank, which is in the case where the agent has a loan from the bank, or the other interest is, or the interest rate is for the fintech. And then it also changes when they get a loan or when they have to pay back the loan. So when they get the loan, then that increases the bank account. So that's assumed here as positive. So in some sense, we're only looking at the balance of the bank account and not at the total wealth. So that's why this L increases their wealth in the bank account. And that just means before they had no loan, and afterwards they had a loan from the bank or the fintech. And we assume that this is just the constant, the L is just a fixed constant. And that's the same for whether they take the loan from the bank or the fintech. And conversely, if they have to pay back, then that decreases it. And when do they pay back? Well, if they have the loan before, so that's why they're sort of, it's denoted by T minus. And when they afterwards have no loan, plus they also need to be high type, because the low types will never pay back. So that's why you see here the additional, at the very end, the additional condition here of being a high type, because only the high types pay back. And then we just need some sort of technical condition so that it will not happen that sort of this infinite consumption, and that is avoided by making a condition on the limit as s goes to infinity. So that would be just a condition to avoid that. So important, we have here now 4 different rates. One is the discount rate, which is the rho. Then there's the savings account rate, the R, and then there's RB and RF from the bank and the fintech, and they can all be different. Additionally, we had the loan amount. As I said, that's a constant, and we have the alphas, the agent's decision over there maximizing, and that can depend on the type of the agent, but it won't depend on time. Now, because that is sort of a linear form, we can extract the wealth variable, and then also it's sort of multiplicative in L, and write this just as this V function, which is given here, okay, relatively lengthy expression. But the point is that we can get rid of sort of the wealth dependence, and we can get rid of the L dependence, and then just look at essentially the decision here only over over the alpha. So in particular, I have here one example. So this would be the one about the ones who have the a loan from the bank, high type, non-privacy conscious. And what they are doing there is they have to pay interest. So that's why it's the first expression until the maturity of the loan. And then at that moment, they will become then a non-loan agent. So that's why we have then on this side the NHQ. And that's then sort of just discounted, and that gives us this expression, which means that this satisfies a dynamic borrowing principle, which then also means that we can derive HGB equations for this value function. And they look actually very nice in this case, because they are quite simple in terms of the dependence structure. In particular, we see here it depends on the discount factor and sort of the maturity frequency, as well as these different interest rates. And then, of course, the alphas, which are the important part because they are these decision variables. Now we get back to the screening, because that will affect then the decision variables. So the screening, we assume that was before denoted by xj, and now we assume that we have this sort of xf and xp. Xf is the one for the fintech, and before open banking, we assume that this is lower than the one for the bank. Why? Because the bank has sort of all the transaction data. So we assume that gives them a competitive advantage over the fintech. Whereas after open banking, and for agents who participate in open banking, this will just be the opposite, in the sense that now the fintech will have a higher screening ability than the bank. So with open banking, it doesn't change the bank's screening ability, because they still have the data, but it will increase the one of the fintech. And we actually assume that it will increase it more than just to the one of the bank, but it will then actually be higher than that of the bank, because we assume that they have sort of better analytical methods to estimate the default probability. And that's typically what we would sort of expect, because that's a model where we have fintech companies that have access to also other data and other methods, which are sort of more sophisticated, and that allows them to get even better than the bank. With that, we can actually derive explicit expressions for these different alpha decision variables. And I mean, I will not go into the details, because they don't matter that much. The point is just these, they will all depend on the underlying parameters, and they're all explicit, and they depend also on sort of the loan frequencies, and of course the screening ability parameters that then appears in these different decision variables. Okay, now let me get to the impact of open banking. And there we're looking at two different setups. The first one will be very short, only this slide. And this is just to show that we can do it in two ways. That is a mandatory sign up. In that case, all agents are required to sign up, but that's probably not how it will be in reality. So this is just to see what's happening there. And then even there, what can happen is that high type borrowers, they can actually be worse off. And now we are focusing here on the sort of the bad case, because this is, I would say, the more unexpected result. And well, they are worse off exactly when the expected interest rate after introduction of open banking is higher than that one before. And that's what this this inequality says. And there's also situations where the low type borrowers are worse off. And that's now more complicated because in this case, also the default probabilities matter because some of them will default, and that will be sort of then in some sense it will be normalized by that probability. So that's why the expressions for the low type borrowers are more complicated than that for the high type borrowers. But the point is that both of these situations can happen, so that under mandatory sign up, it can be that both of them are worse off. Now, what I would like to focus on is the other setup where there is voluntary sign up, because that's also what would be then in reality. And there we assume that there's a cost for each agent to sign up. And that's denoted by C, and that will be important for the later results. And that cost, it can be a financial cost in the sense that they would need to pay something for using open banking, but it can also be a cost that just reflects that it takes time to learn how this works, or that there's sort of a convenience factor and inconvenience factor. So it just means a participation costs of open banking, and that's a one-time thing that will be charged when they sign up to open banking. And now the non-privacy conscious agents, they sign up exactly if their welfare is increased after that cost. So that would be the welfare before the cost is the V, afterwards is denoted by V prime, but then the welfare being increased, it should mean that V prime minus the cost is still higher than V, and then they will sign up, and otherwise they will not sign up. Now, the privacy conscious, I should also mention that they will never sign up, because you can think of privacy conscious as having sort of a C of infinity, and they will never sign up just because they don't want to share their data. And then we have the notation here, tau, which is the proportion of phi. Well, it's a function of the proportion of the high types. And we consider the value functions now as functions of tau. So it's no more a function of time, but a function of tau. This is how we consider them here. And then also in the next result. This was just a reminder that that S still denotes the proportion of privacy concerns agents. And we use additional notation for the measure of the non-privacy conscious agents who sign up. So that is denoted by beta H and the corresponding here epsilons. Now, if you look at the, let's say this expression here, then the here the mu's, they are just the sum of the measures of the non-privacy conscious high types, and we look at the measure of how many of them sort of signed up, and that gives us then sort of the beta H. And similarly for the low type, the beta L is just the one which uses the same expressions for the low types. Now you should think of this in the following way. So we have the measure 1, and then the privacy conscious on the left, they will never sign up. For us, for the non-privacy conscious, some of them will sign up, others don't, and that depends exactly on these, or is denoted by these measures. And they could be, it could actually be, it could be 0, it could be everything, or it could be somewhere in between, as illustrated in this figure. And now what we are looking at here are different types of equilibria, and they will crucially depend on the sign-up cost C. So if the sign-up cost is in some interval, depending on the value of the value functions, then a separating equilibrium arises. And that means here that all the non-privacy conscious high types sign up, because the high types will have sort of a bigger benefit for signing up, and they will all sign up, and the low types will not sign up. Because, well, they would actually also benefit from signing up, but the cost is sort of too high to sign up, which means they will not sign up. And what that in turn means is that, of course, the high types, they will benefit from better conditions because they are now sort of separated. And that's the thing, because the fintech and the bank, they know who signed up for open banking, so they can identify them clearly. Whereas, well, all the low types will remain, plus the privacy conscious high types, they will also remain, which means all these agents will have worse conditions than previously. Then in the second case, it's sort of sometimes the opposite case, which is a pooling equilibrium. And that is when the costs are low enough, then everyone signs up. And in that case, I mean, everyone, all the non-privacy conscious sign up, but everyone in terms of high or low type. And in that case, these agents will benefit, and the others, well, that depends then on the initial distribution, but assuming independence in that of the criteria between privacy consciousness and high and low type, then the others will not be affected, because then it's just a sort of a fraction of equally distributed agents will leave, but then the other ones will still have the same conditions. And then there's a third one, which is semi-separating. And here, what's happening is that a part of the high type and a part of the low type non-privacy conscious borrowers sign up. And that is now something which is actually between sort of strictly between 0 and 1. And in that case, what can actually happen is, in some sense, everyone gets worse conditions, because the ones who sign up, they may get worse conditions depending on the screening abilities, as they may actually be sort of, if the fintech has a bigger competitive advantage over the bank, they may get worse condition there. And the ones who don't sign up, they may get worse conditions because in some sense, the good risks may have sort of left, or some of the good risk, and that's why sort of they may get worse conditions there. So there are situations where everyone is worse off in that case. And again, that depends largely on the costs. And we see that illustrated here. So on the y-axis, you see the cost, so that's the C, and on the x-axis, that's the theta, the proportion of high types. Now, if the cost is very low, then there can be a pooling equilibrium, which is the one here in red. And then if the cost is a bit higher, there can be a semi-separating equilibrium. And if it's sort of even higher, then there's a separating equilibrium. Now, but you also can see there's a lot of blank space, which means not every point is sort of achievable in equilibrium. Sort of only what you can see here is achievable in equilibrium. And what's also interesting to point out is that the red and the blues are actually regions, whereas the green one, the semi-separating, that's only a curve. And that's only a curve because in that case, you need sort of to have a strict, well, you need to have an equality, whereas in the other cases, there's inequality for that need to be satisfied. So that's why in the case of a semi-separating equilibrium, there's just a curve. Now we can also look at the beta values and how they affect the reaction of the lenders. So depending on what values these beta take, the lenders will be both active or non-active or only one of them, and that then also affects their profit. And this is depending on the participation condition that we saw earlier. So that is satisfied in some cases, in others not. And that then also depends whether it's the bank or the fintech and whether it's open banking or without open banking. However, that is not all of these regions are achievable. And you see this, let's first look at the left part. So in the left part, we have the achieved value for a fixed, plotted for a fixed theta. And there, what's happening is that for theta equal to 0.95, you see it's only a dashed line, and that is because this is not an equilibrium. You see that here. This is just outside the 0.95 is just outside the green curve there. So that's why there's no feasible equilibrium. And for the other ones, it will just be a curve. Now, this looks like they look like straight lines, but they're not. I mean, they're approximately straight lines, but not exactly. And then we can look at how these are related to the offerings. And what you can see in all these cases, that's in the region where there are both lenders offering loans. Even in the case of this highest theta, but it's still an equilibrium is still not feasible. Now, let me finally look at the profit, how that affects the lenders. Now, generally, the bank will have lower profit with the introduction of open banking, and that's also not really surprising because there's more sort of competition from the fintech. But regardless of how the parameters look, this will lead to reduced profit. Now, overall, the profit sort of industry-wide, which means banks and fintech profit, that depends on the structure of the screening ability. So if the screening ability after open banking, the difference in them is bigger than the difference in the screening abilities before, then the sort of the fintech has a bigger advantage over the bank compared to the advantage that the bank had over the fintech before open banking. And if that's a situation, then the overall industry profit will increase, and that affects and also the agents. And how much that increases depends on the proportion of low and high types who sign up for open banking. Let me summarize. So we introduced this dynamic model and analyzed the agent's decision in equilibrium. Then the crucial point in the analysis were the sign-up cost C, as they determine which type of equilibrium will arise. And that has then also consequences of welfare distributions between high and low type. And we are working on currently some extensions, in particular in terms of making the sign-up cost random and looking at the robustness of the equilibrium. Thank you very much for your attention.